Hey, what's going on, guys? I'm Aaron Cox with IULaccount.com. I'm making this video right now because I am a licensed life insurance agent. Okay, so my main specialty, my main focus is IULs. All right, I love to work with clients on index universal life policies. In the course of my work, I had a buddy of mine call me to ask me about IULs out of the blue. I guess he'd been talking to another agent, or his one of some constituent his wife knew, and he starts asking me, "Hey, can I get the inside scoop on the IULs?" I said, "Sure." Right, sure. So I start telling him a little about IULs, and he starts talking about, well, Dave Ramsey says, Dave Ramsey, Dave Ramsey. And I'm like, what in the world does Dave Ramsey say? Now, I used to watch Dave Ramsey a couple years ago, 2, 3, 4 years ago. I watched Dave Ramsey. I enjoyed watching Dave Ramsey, or I did. And then I saw this whole litany of videos about IUL's a scam. You know, all these thumbnails of why Dave Ramsey says it's a scam. So I decided to listen to a video. And in this video, we're going to review about a 5-minute video from Dave Ramsey. I can debunk the noise coming out of this Ramsey channel.
Dave, I'm seeing this all over social media. I don't know why, but the young people are gravitating towards these universal life policies, and here's how it's marketed. They go, you're supposed to use your life insurance while you're alive. Did you know that? And everyone's like, oh my gosh, this is brilliant. This investing policy inside of my whole life. Oh my gosh, this is amazing. I'm going to become a millionaire. And the commissions and fees these guys are making selling this crap is insane.
Yeah.
And the amount of time you have to spend pulling that premium every single month in order to make any amount of money is absurd.
Well,
I don't know how it's legal.
The commissions and fees these guys are making is insane. I don't know. See, look, that's just a little tactic right there to undermine and undercut the credibility of the service that people like me provide. I really don't appreciate that, but nonetheless, moving on. Secondly, I have never pitched an IUL policy. Who pitches an IUL policy like that? That's not how you pitch an IUL policy. An IUL, just to clarify for Ramsey viewers, and for Ramsey and his partner himself, because clearly they don't know, they don't understand how these are being sold. An IUL is kind of like having a savings account. It's like having a savings account with a life insurance company instead of with a bank. But the interest rate of there's two components. There's the life insurance component, and then there's the cash value component. And that cash value earns interest based on the stock market. So however the stock market it's indexing, whichever segment it's indexing, how that goes, so too does the cash value grow that interest rate, with the fail-safe caveat that if the market takes a downturn, starts to go down, then your money is protected by a 0% floor. So imagine an account where basically you are able to invest in the stock market and earn interest. You get all the gains without any of the losses. Who would have a problem with that? In what world would you have a problem where you only can get gains and no losses from the market? I don't know. That sounds pretty smart to me. So you've got the high upside potential when the market's good. And then number two, you've got the downside protection if the market goes down. And it's not an if, it's a when. Okay? It's only a function of when it will go down, because the market goes up and down. Okay? So you're getting all the gains, and when it goes down, you're just plateauing. Right? So you get all the gains, none of the losses. Thirdly, you have a guaranteed death benefit. So while you're saving for the future, in case something were to happen to you, your income is provided to the family. In case something were to happen, you have a guaranteed death benefit. You have a guaranteed death benefit. Okay? And lastly, this is all, number 4, a tax-free asset. So your money grows tax-free. If you need to borrow it, you need to take a loan out from your insurance, you get it tax-free. And when you leave it to your beneficiaries, it's tax-free. Where else do you get that kind of product? If you're flipping houses or you're investing in the market, directly, you're going to pay capital gains tax. You're going to pay, you have ordinary income tax. In what world is tax-free savings a disadvantage? Okay.
The indexed universal policy is it's a newer version of an old bad idea, is what it amounts to. And so what you're going to find if you take this product apart and look at the components of it, the insurance portion goes up every year. It's basically what we call an ART, an annual renewable term. Term insurance, all life insurance gets more expensive every year that you're alive, period, because you're statistically more likely to die every year you're alive, right?
Brilliant.
So if you're 51, you're more likely to die statistically than if you're 50, period. Okay, end of story. Now, how do you get then a 15 or a 20-year level term insurance? Well, it is cheaper than the average of the 15-year of increases. The ART would start out cheaper and it would end higher, and the lines would cross right in the middle, hypothetically, if it was exactly how, you see what I'm saying? So the ART would go, it'd go straight up, and the 15-year would be level, and it would cross right in the middle at 7.5 years. However, it doesn't do that because it is cheaper for an insurance company to produce a 15-year policy because they keep you for 15 years. Then it's called persistence in the insurance business, than it is for them to try to get you to stay with a policy that goes up every year. Can you imagine that if you get a bill and every year it goes up, you're probably more likely to cancel that? So that policy doesn't stay on the books, so it's more expensive for them to sell ARTs. So net result is a 15-year is way cheaper than the average of 15 years of ART. Okay? Now, the index universal goes up every year inside the policy, but you don't see it. So if you got a $400 premium, a certain portion, like on your, if you ever look at your mortgage payment, a portion goes to interest, a portion goes to principal. The further you go along, more goes to principal, less goes to interest. This is exactly the opposite. The further you go along, more goes to insurance, less goes, because the ART is going up every year inside there, less is going to your investments. And so if you keep the stupid thing long enough, it will begin to be the point that the premium you're paying will not even cover the insurance cost.
Oof.
And so it starts to eat back into your savings just to keep the policy alive. And the thing gets what we call upside down in the insurance business. And so now you've got a real piece of crap that's eating itself from the inside out.
But they pitch it as this really sophisticated, nuanced.
Listen,
it's so complicated you don't understand. Just trust me.
Yeah.
As your insurance guy, I'm going to make you lots of money.
Okay, so I switched to Zoom. Sorry, I know the audio is probably not as clear, but I wanted to do this because it's easier for me to illustrate the phenomenon Dave Ramsey is trying to scare everybody with. What I did was I did a sample illustration. See, it says here, sample 31-year-old client, male, age 31 in California, non-smoker. I set this up as $1,000 a month, and I chose option B, which is an increasing premium, an increasing death benefit, not an increasing premium, increasing death benefit. So the face amount starts at 561,370. And that right there is the amount that the beneficiaries would receive day one. God forbid something happens to this client. If something were to happen, they get in a car accident, God forbid, and they transition to the heavens tomorrow after they did the agreement the next day, this is what their family would receive tax-free. Okay, so right here, I'm going to show you how this grows, and then I'm going to show you the cost. And we're going to talk about does what Dave Ramsey say, is that worth even worrying about? Is it worth the grain of salt? Is it worth the breath he wasted to even say that? So here's how you read this thing, looking from left to right. After 1 year of making $1,000 a month payments for 12 months, you've paid $12,000. He'll be 32 years old after a year. This column is the interest rate that best reflects the current market. This is a conservative interest rate for this particular carrier. Okay, so after 10 years, this net death benefit shows that the death benefit is rising every single year. It's getting more and more and more. As they age gracefully, this death benefit raises. Okay. The account value is how much money is in the account, in the actual cash value of the IUL account. The surrender value is how much of the money that's in the account you have access to. Now, with this particular carrier, in year one, it should say 0. You can't, usually in a lot of IULs, you can't take out any money in the first year. Okay. So you'll see that in the beginning years, 1 through 10, you have access to about 85 to 95%. As we get down to year 15, 16, in year 16, you have access to 100% of the money in your IUL account, in your cash value. Okay. Now, this death benefit, again, it keeps going up. After 10 years of contributing $12,000 a year, you've put in 120,000. You have 128,187 available. All right. After 20 years, the client's now 51 years old. He's put in 240,000, and he has a available $412,089. Okay. The death benefit is almost $1 million. Okay. After 30 years, this client has put in 360,000, but the cash value is going on tripled almost. Excuse me. A 969, almost 970,000 in cash value has accumulated. Okay, again with this conservative interest rate of 6.54%. I think I did this up to age 65, and then I decided he would retire and take an income. Yes. So at 65, that's the last year he pays into the policy. He's now got a cash value of over 1.3 million with a death benefit of over 1.8 million. And at this point, at the age of 66, he stops contributing to the policy and starts taking withdrawals of $116,249 every year. And that's their salary that they're living off of. They've created this retirement income. If they took an income for the next 25 years, that take them to age 90. Average life expectancy in the United States is about 78 years old. But they have basically, off of a lifetime contribution of $408,000, they have created a potential retirement income of basically 2.9 million. Okay. So obviously the client could, maybe they don't think they're going to live till 90. They could take a little more. This is just a projection of how the numbers could go. Anything could change where, maybe you withdrew some money earlier, or it doesn't have to be just like it is on the paper. But that's what you're essentially doing. You're basically putting your money into the insurance company and using the interest that's generated off of the index equity, the index stock market that you're using to create retirement income for yourself. Okay, so now let's get to the cost, because this is where Dave Ramsey is doing everybody a disservice. Okay. What I did, it'll be easier because this person takes an income. I'm going to switch to this other illustration. It's the exact same numbers. The only thing I didn't do was take an income. So watch this. 36. Here it is right here. Sample 31. Sample, same age, everything's the same, right? And I'll just show you the tabular detail one more time. We're still looking at the same type of growth. Let me slide this over. Okay. So still after 10 years, 128,187. Still all this is the same. Okay. Only thing I did was I stopped the income. I stopped the contributions at 65 like I did before, but I did not take out any loans. Okay. I didn't take a retirement income. All right, so that's going to make this easier to see. Now we're going to look at the cost of the policy, because this is where he's talking about it goes upside down and it starts to implode from the inside and all this kind of hyperbole. And I'm going to show you where that's false. That's just noise. Okay. So here's the charges on this policy, charges and expenses. What you'll see is that there's a premium expense charge, and that's pretty much, changes somewhat over the years, but it's pretty steady. Here's an expense charge that changes, is pretty much steady. It has its changes over the years, but it doesn't change. It's pretty constant for some time. But where he's right, the cost of insurance as we get older, it does change. It goes up every year because we're older. So the cost of insurance does increase. But why am I worried about this? Let's look. At 65 years old, the cost of insurance is $4,206. Now he's put in $12,000, so still his $12,000 is still covering the cost of insurance. But let's go to age 85. Let's just go look at that. Or let's go to age, it doesn't matter. Let's just go to, this is convenient. Let's see here. Well, let's go cost of insurance at age 81. At age 81, now he's not putting anything into the policy, $0. Pay attention to this. This is the critical thing. He's not putting anything into the policy. The cost of the insurance is over $25,000, $25,843, plus the expense charge of $108. So basically $25,900 something dollars, $950 almost. Okay. But that's how much you paid this year. Look at the surrender value. Look at the cash value. This person is earning from one year to the next in interest. They're earning about $125,000. Maybe that's like 200,000. The close to 200,000 from this year to this year, and from this year to this year. This person is making, in fact, from this year to this year, it's over $200,000. Now, let me ask you, any person listening to this video, if I ask you to pay me $30,000, and in 1 year, I'm going to give you $200,000. That's just good business. I'm going to do that all day, every day. Why am I going to be worried about the cost of insurance if I'm handing you back almost 10 times what you're paying me, what your costs are? It's going to cost money to make money. That's the whole idea behind these policies, is that you get in, you start contributing, and you earn more money than it costs you. So to see what he's done is he's talking about the cost and how, yes, he's right. The cost of the insurance is more than what you were paying. You were paying $12,000 a year, and now at this point, the cost of the insurance at 75 years old is $12,680, and from there, it's more than how much you were even putting in the policy in the first place. That's true, but it does not exist in a vacuum. It does not exist in a vacuum. And that's where it's false. That's where his whole premise, I want to destroy that whole argument, because what you're making on the interest at this point, when that happens, when what he's talking about, when the phenomenon that he talks about happens, by the time that happens, the interest you're making on the policy is so much greater that you're not even concerned about that. See, one thing he didn't even mention, one thing maybe he doesn't know, when you take loans out from yourself, there are various types of loans, and you can take one. It could be called an alternate loan, a variable loan, or a participation loan. You can take a loan. I could take right here. I've got almost $3 million. I could take $2 million out and invest that into, I don't know, a shoe store, Burger Palace, my burger grill, whatever. And I can make money off of that, whatever I've invested in, but I can still have that money earn interest when inside of the policy as if I never took it out. And that's a component of the infinite banking strategy, because you put the money into something else, you've taken it out of the IUL policy, but the IUL policy is still using that money to put towards the basis of the interest earnings you're making every year. If you cannot see the logic behind paying a cost of insurance of even 30 grand, shoot, look, 70,000, look at this here. At 90 years old, almost, let's just say 75,000. You have to cut, the cost is 75,000. But you've made almost 400,000. It's a no-brainer. It's a no-brainer. So the argument Dave Ramsey is making is a complete misnomer. And to sit here and scare people from IUL policies based on that, got to be ashamed of himself. Just shame.
Let me give you a clue. Okay, when you drive past most cities, the skyline has banks and life insurance companies. These are the two towers in every skyline. Santa Claus didn't build those. And those people didn't build them with wealth they inherited. They built them with money they took from you. Banks screwing you. Life insurance companies screwing you. This has been going on for decades.
Nothing new.
It's not a new song, not a new dance. And just because you put it on TikTok, for God's sakes, doesn't make it smart. As a matter of fact, that kind of dumbs it down.
Dave, that's a trigger word for you. I'm sorry. I shouldn't have mentioned anything.
I mean,
but
it's just like...
What we teach is that you should take the difference. That if you pay $5 for term life versus $100 for whole life, take the $95 you would have spent and invest that. And you're going to be way better off than having touched one of these crappy policies.
Yeah. Oh,
see, Dave Ramsey is always advocating that you should separate your investment strategy from your life insurance policy. And right here, they're saying you should, get the cheapest term policy you could get, essentially, and then invest the rest. But that's so vague. Invested in what? Where are you going to invest? What? Most people cannot compete with stock traders, stockbrokers, investment portfolio managers that do this for a living, 9 to 5, as long as the markets are open. They can't compete. These guys know how to make money when the market's a bear. So the average person they're going to put their money, if they go get Robinhood, whatever they're going to get, investing in the market. Shoot, the average person with the 401k, they've seen that their money's directly invested in the market goes up, but it goes down. They have to recover. Imagine having an account like an IUL account where you don't have to recover. And the money you put into that account, you never pay taxes on it ever again. That's huge. Your 401k, you grow $1 million in there. Most middle-class Americans are paying right around 30% in state and federal taxes. You grow $1 million in your 401k, guess what? You're going to net $700,000. You grow $1 million in your IUL account, guess what? You net $1 million. What is he talking to you about investing in? Invest that. What? Where? In your 401k? Where does he want you to put? Go flip some houses? You go flip some houses, the barrier of entry, the cost of the down payment on the house, all that kind of stuff. There's way more cost involved. You got to remodel it, hope you can fix it up. By the time you fix it up, you're hoping it's in a seller's market so that you can flip this puppy really quickly. It's not sitting on the market there's a whole lot of things that have to go right. So you tell me how an IUL account is a scam. That's hogwash, man. That's hogwash. I can't even believe he's saying that. Now, for me, it calls into question every other piece of financial advice I've ever listened to from him, because he's telling this half. There's some truth to it, but it's not the whole picture. And they sitting up here on a mic making all types of money talking about stuff that they half know about. Nobody's talking about that. You want to talk about the fees and commissions that life insurance agents make? Most life insurance agents, they're not even making it. Man, I tell you.
Here, by the way, after you paid extra on this all these years and you die, they only pay the face value. They don't pay the face value plus your savings that you've been paying extra to build. So it's like a savings account with a crummy rate of return.
They get locked
that
up.
When you die, they keep your money. I mean, who would bank with that? Oh, people that buy stuff on TikTok.
I think Danny needs better friends.
Yeah, well.
It's time.
No, I mean, that happens to everybody. Because that's how most, particularly whole life, permanent life, crappy life insurance is sold, is some old friend from college suddenly remembers you.
My buddy from Northwestern Mutual said,
yeah, for God's
let's be done with that.
Oh, that's horrible. That happened to me. I bought it
We've all been
when
there.
I was a child boy. Yep, sure did. I did the same stupid stuff, and I have a degree in finance, and I fell for the crap.
Now he's a grown man, America. He made it.
Man, I tell you. Wow. I can't believe Ramsey is saying this. I can't believe that's coming out of his mouth. This guy, I tell you one thing I know for sure. If you're thinking about opening an IUL, don't check with Ramsey. Talk to a licensed life insurance agent like myself. You can hit me up, IULaccount.com. Talk to someone that knows something about it, because he is just way off. Look, I'm going to prove it. Look. The death benefit, he's saying right now that you only get the face amount. You don't get the cash value when you die and leave money to your beneficiaries. I'm going to show you how wrong he is. So look back at the original policy I was showing you before. Okay. Here's your account value. Again, that's the money you've saved in cash value you've accumulated. This is it. If you take the cash value that you've saved, 9,564, and you add that to the original face amount of the policy, 561,370. After 1 year, you've accumulated 9,564. You add that to the face amount, it equals the net death benefit every single time. Add this to that, it will equal that. Your family, I don't care. With option B in particular, your family will get the cash value plus the original face amount of the policy. That will equal the net death benefit that goes to your beneficiaries every time. How is he sitting up here with millions of views? I don't even know how many subscribers, and talking about IULs are a scam, and he doesn't even know that. It's math. It's math. I like Dave Ramsey. I believe that he means well, but don't listen to him when it comes to IULs for sure. Don't listen to him. He's not somebody you should. He's not a licensed life insurance agent, as far as I know. Yeah. Hopefully, I've destroyed this whole obstacle I have to people that follow his disciples, that follow Dave Ramsey. Hopefully I've put an end to that. Anyways, thank you guys. And like I said, feel free to go to my site, IULaccount.com. I'd love to work with you.